Why do startups fail? Well, we're going to take a look now at what I've called strategic pre-investment issues. These are critical issues which can be identified in the due diligence process. These are core issues at the heart of any startup project. Now, if you're an investor, these can be litmus tests that you need to carry out. And if you're a founder, then these are issues that you really need to check your project is not flawed by, because they can be potentially fatal. Now, there are 8 of these issues in what I've called this pre-investment stage, and they are no market need, not the right team, user unfriendly product, good idea, bad business, legal challenges, lack of passion, no investor interest, and sector issues. So you can see that any of these are things that investors would be asking a startup CEO and founder and the team about, trying to get to the bottom of. And I'm almost giving them to you now as a sort of checklist that you can work through. Let's take a look at them one issue at a time, just to explore them in a little more depth. The first of these is no market need. Now, this is a real red flag issue. It's the major reason for failure, and it should be something that you're really looking at. Basically, does the company have customers? And if not, is it because they're not interested in the product? There are plenty of great tech ideas out there for which fundamentally there is no use. You can come up with loads and loads of stuff, but it's not really going to help anybody. So you need to ask yourself, what is the problem that is being solved? What is the pain that is being addressed? And critically, is it a large enough market to be worthwhile? And is it scalable? So without those 4 issues, or really 3 issues, because pain and problem are the same thing, pain, large market, and scalability, basically you may not have a business. There may be no requirement in the market for this product, service, solution, whatever it is. The answer to this is to make something people want. Entrepreneurs are always too confident about how easy it's going to be to get their customers. And you need to see and understand, is the company struggling to develop customer interest? Because if it is, it could be a real issue. And what they need to do is to ensure they're solving a meaningful problem for other people. The second issue is not the right team. This is also critical. Are there weaknesses or gaps in the team of founders who are presenting to you? And if there are, can you change or fill them? Can the current team, as constituted, create the product and bring it to market successfully? Or are they relying on freelancers or contract workers for some critical skills? Another issue, of course, is the balance in the team. Does the team balance itself out in terms of personality and in terms of the way they work together? Because an out-of-control CEO can be just as dangerous. Or has the CEO listening to and working cooperatively with his or her founders? Now, the way the team is constituted may simply be down to inexperience and naivety, and it could be, with a little bit of experience coming in from the outside, something that can be fixed. But you do need to understand whether you've got the right team in front of you. Now, if you haven't got the right team, this might be enough for you to walk away from the opportunity. Essentially, you may have a team who are poor at strategy. They can build a product, but nobody wants it. They're poor at execution. They've got a product, but they can't build it on time or to an acceptable quality. Or they're poor at team building. Now, the old adage here is that A players hire A players, but B players hire C players, because B players don't want to work for B players. So you can see the problem. Another statistic which is quite interesting is that solo founders take 3.6 times longer to outgrow the startup phase. So you need to have your team balanced with, as they say, a hipster, a hacker, and a hustler, a designer, a techie, and a biz dev guy. And that is the core essence of a balanced team. Issue number 3 is a user-unfriendly product. People often are tempted to build what they think people want, not what they need. And it it can end up with a very clunky and unuser-friendly product, and it's not at all appealing. You need to make sure the product's easy to use, it's fun to use, and it's something users want to come back for. One way to due diligence this is to spend time with early adopters and get their feedback on the product. Now, this should be happening all the time, because the first iteration of the product is certainly not going to be the last, and new features should be brought into it all the time. Now, if the business is pre-sales, find out more about who the leads are, who the potential customers are, and what their feedback is to the product or service. Number 4, what I've called good idea, bad business, is essentially a product without a business model. Now, there were plenty of those in the dot-com boom. If we build it, they will come. Well, I'm very sorry, but they won't. So how is the product going to make money is the critical question. Who's going to buy it and how much for? And if the business is offering just a sort of free service, how can they move from free to paid? And can the product scale? It's a very, very simple issue, this. Either the product can make money or it can't. And if it can't, then you shouldn't waste any time on it. A product without a business model, good idea, bad business, leads you to then ask more questions. You know, if you're looking at a product and a service, is there a compelling use for it? Or is it just a clever technology or an idea? Can you find a scalable way to acquire customers? This is critical, because the cost of acquisition of a customer must be significantly less than the lifetime value of that customer. So can you monetize your customers at a significantly higher level than your cost of acquisition? And ideally, you want to recover your cost of customer acquisition in under 12 months. So these are good metrics and tests that you can apply to see if there really is a business model there. Legal challenges can be fatal. So when you're doing your pre-investment due diligence, you need to check to see if there are any legal issues outstanding. Because one of the ways that people compete in this market, and particularly well-funded, already established companies, is when they see a disruptive competitor arising, they start hitting them with legal problems. And the established competitor will have the checkbook to do that, and the startup will struggle. Legal challenges are very expensive, and when they come from a major competitor who has the firepower to drag you through the courts, as an investor, this should be a red flag. Now, these challenges, of course, may emerge later, and the best response may be to retreat, pivot, rather than to stand and fight. Lack of passion in the founder team can be critical. The team has to be passionate about their business, and particularly the area their business is in. And if their business and their interest is focused solely on how much money they're going to make, as an investor, I would move on. This is something that will become apparent when you spend time with the management team and you talk to them and you listen to how they're behaving and the way they're thinking about their whole business. But it is something you need to have your antennae tuned into. No financing or investor interest. Now, before you invest in your angel round, look ahead to anticipate the Series A round and think about how those investors will respond to your startup. Look at the major trends in the industry and the sector. How competitive is the space? What comparative deals can you identify? It may be that you're already too late. The train has already left the station and there are 2 or 3 really well-funded businesses doing what you're doing, and it's going to be very difficult to get interest from other investors. If you can, try to identify early on likely Series A investors, and you need to make sure that 1, they've got funds, secondly, they haven't got any conflicts of interest, i.e. they've already invested in the domain. You may find that this is a geographic issue, that you've got plenty of investors in San Francisco, but your startup's in London, for instance, although the London startup scene is very hot at the moment. Has a competitor already claimed the space? Because if a major competitor has already done a large capital raise, they will have the resources and the investors potentially to win at any cost. And if you're not sure about that, just see who's been trying to compete with Uber in the taxi space, or Airbnb in the flat rental space. And I think you'll see that it's very difficult to compete with a very well-funded major established player. The final one is sector issues. Now, there's a lot of sector favoritism, a lot of sector faddishness and trends which can affect whether or not investors want to invest in the sector. You've also got particular characteristics in particular sectors, and the challenge here is if you don't know the sector, you need to be particularly cautious about how you invest. But some examples, software companies can get really tied up in their tech and sometimes lose sight of their customers and the market fit their products trying to develop for. Social media startups can struggle to get traction and will have problems sometimes developing a viable business model. Mobile apps have sometimes no clear route to a sustainable business model and to a market. An app is great, but it's very difficult to turn it into a business. In the fashion sector, there can be cash issues. You get a lot of highly creative people, but they may not always be focusing on the finances as closely as they need to. And the failure to secure funding or indeed running out of cash is a typical problem in that sector. In the music sector, there are a lot of technical issues and a lot of legal challenges from the incumbent players who are trying to maintain their hegemony over the sector. So the question to you is, what is your sector expertise and what sectors are you going to focus on to make sure that you really understand the type of company you're investing in? So those are some of the pre-investment issues which are critical. Now in the next video we're going to take a look at some external issues which are only likely to come to light after an investment has been made. So do startups fail? Strategic pre-investment issues. I hope you found those enlightening. Almost certainly these are just the start of your journey. You're going to have to investigate these factors a lot more, particularly if you're looking at making an investment in a startup or you're a founder in a startup and for any reason you're struggling.